All right, let's dive into this explainer on a crazy, counterintuitive link between war and the stock market. We always assume geopolitical conflict just crushes markets, right? But what if the exact opposite is true? Well, some brilliant academics actually tackled this exact mystery in the prestigious Journal of Finance.
They wanted to know, could measuring our collective fear through media coverage actually predict future stock returns? To find out, they analyzed a literally staggering 7 million New York Times articles.
This massive dataset captured human attention and fear across almost 160 years of history.
They built a specialized machine learning model specifically trained to track one single seed word, war.
The results are absolutely wild. Higher war coverage directly predicts higher stock market returns.
Yeah, a typical spike in war news predicts a massive 3.8% jump in annualized returns. And get this, that war return premium actually persists for up to 3 full years later.
So, why on earth does widespread panic create such a robust market premium?
Researchers narrowed it down to 2 camps, a rational risk premium or an irrational behavioral response. Rationally, terrified investors demand way higher compensation for catastrophic risk, driving current asset prices down. Behaviorally, the sheer media noise makes us panic and just wildly overestimate the actual danger.
But both theories lead to the exact same reality. Excessive pessimism creates severely underpriced assets.
Now let's look at the cross-section, meaning how this actually affects individual stocks differently. It turns out how a specific stock reacts to the threat of war totally dictates its future value. Since investors are terrified, they massively overpay for assets they think will safely hedge against conflict.
Conversely, they completely dump stocks vulnerable to war, driving those prices down to absolute bargain levels.
So ironically, stocks highly sensitive to war risk will actually earn you lower expected returns.
And crucially, this specific war factor is a totally distinct tail risk from your standard market downturns.
Plus, the data proves this premium is driven entirely by factual news reporting, not just opinion pieces.
The ultimate takeaway? Tracking mass media discourse can actually reveal massive, predictable behavioral mispricing. So when the next terrifying headline hits, are you going to follow the fear or follow the data?